Unfortunately, the majority of what you've been taught about money and investing is wrong, and it's flat out going to make you poor. From compound interest, a big sacred cow, to being in it for the long haul, to handing your money over to Wall Street, or taking risk to try and get a return, and trading time for money when it comes to your work. No matter how hard you try or how much you work, these strategies will make everyone rich but you. Look, at one time, I was part of the problem. When I started in finance, I was in college and I was lectured by this professor on the merits of taking risk if you wanted to get wealthy. Now, I ended up having another professor that was phenomenal and was actually a fund manager of $5 billion in muni bonds before he became a professor. This other one was just giving me charts and showing like aggressive always wins. But putting money in more aggressive mutual funds, well, I bought into that at first. It was like hook, line, and sinker, and it was in the 90s, so it just felt like the market was never gonna stop. It was only gonna go up. I figured I should put every dollar I possibly could into a 401k. That if I could just save and scrimp and sock everything away, I could live a much better life one day, someday, way into the future. But look, nobody told me about downturns or risk management at that time. Nobody was focused on cash flow. It was all around accumulation. And unfortunately, I was in the financial industry. I told my family and friends to cash out their bonds, their CDs, their savings accounts to put money in the market, which they knew very little about. And I gotta tell you, I learned a really difficult, very hard lesson. But through research, infinite curiosity, and learning from the greatest financial minds of the time, I'm gonna show you the top 10 ideas that absolutely destroy wealth. And if you know how to avoid these, you can embrace wealth. So let me break this down into 10 simple parts for you. Number one, look, this has been a bill of goods that's sold and it's defunct. Avoidance, lack of responsibility, thinking someone else is gonna care more about your money than you and someone else is gonna take care of you. Those that don't pay attention to something, yet expect results, will be heavily disappointed. Investing has been twisted to have people believe that they can hand their money over and get rich. If there were a magic investment, we'd all own it. We would all be rich. There is no one riding in on some white horse to save you though. The only way to have freedom is with responsibility. To do well with investing, it requires becoming a good investor. The best investment though is in yourself. Yet those that want your money will never tell you this and they would never support it whatsoever. Why? Where's their commission? How they get a payoff. I know that the story is, give your money to someone smarter than you and watch it grow. Hey, if they were so smart, why would they need your money? Where's the list and line of all those that are gaining so much wealth from them? Those that gain wealth develop their abilities, their knowledge, and their value creation. I get it. It seems like it makes sense. Oh yeah, this person's a deep expert, and what do I know? I'll just hand the money over to them. Look, that expertise has failed over and over again because it changes hands from one fund manager to the next. It's, hamstrung by what their restrictions are and objectives within those funds. It's reporting average versus actual returns. It's really a lot of marketing hype and hope that has misled and let people down. If you want to have more wealth in your life, it's about creating more value. It's about understanding where you can deliver that value because dollars will follow the value that you create. Those that want passive income without effort will just watch money pass them by. This is one of the great lies that are told by those that want to make money on your money and have you take risk while they get return. I mean, those that say it takes money to make money, whose money does it take? It doesn't take their money. Those people that say high risk equals high return are taking no risk. They're having you take the risk while they get the return. And if they fail, well, they got the government to bail them out. Don't follow that path anymore. Let's get to the second piece here. The second piece is this lie that wealth is somehow about being miserly and that if you just cut back enough and you cut enough things out, you'll be wealthy. Look, I read The Millionaire Next Door. I know there are miserable millionaires that do everything they can to never spend a cent. But if there's something to write down, if there's something to remember, if there's something to imprint into your life, it's that you don't shrink your way to wealth. There's only so much you can cut back. It's a very limited game. There's only so much money that you could save. The question is, if you sacrifice now, are you actually guaranteed a better life in the future? If you have a habit for decades of just accumulation and cutting back and living in scarcity, will you be able to flip some switch sometime in the future and finally enjoy your life? Look, I think that our habits start to become who we are, and if we have 30 years of sacrifice, it's going to be hard to be in abundance one day and enjoy life. Look, there's 3 ways to live within your means, right? One takes discipline, the other 2 take knowledge. It takes discipline to budget. It sucks. It's hard. The question is, do you prefer to work hard forever or to actually gain the knowledge, which may be temporary hard work, but you can set yourself up for ever more. Efficiency and expansion are the other two factors, and they are the key. So instead of relying on the philosophy of budgeting, just grab my newest book, budgetingsucks.com. And I know, mentioning a book on YouTube, how dare I? But the bottom line is it's such a low investment to have a major payoff, all right? Let's go to the third piece here. Third thing that is going to destroy wealth is to borrow money to consume and getting stuck in materialism. This is buying things you don't want to impress people that you don't like. Consumerism is one of the greatest ways to destroy wealth and stay stuck. From the notion of an American dream that's all about buying a home, cars, and other things to prove success, chase happiness, and mostly stay stuck in having to work harder to buy more or maintain what you've bought. Look, people typically hate debt. Unfortunately, they lump all loans into the idea of debt. What really creates debt is borrowing for things that aren't assets, things that don't create more cash flow than they actually cost. Like going on a trip you can't afford, putting it on a credit card, and then coming home owing something but not having anything left to show for it. The habit of buying something to make you feel better, to feel worthy, is absolutely going to decimate wealth. To feel important, to chase being happy is destructive and will destroy wealth if that comes with consumption. It's time to escape consumption and move to profitability and production through value creation. The fourth piece here, accumulation. I know you've heard it before. It's the main message that we're taught, right? Good things come to those who wait. Invest early, often, and always. Compound interest is a miracle. Compound interest is only a miracle that we believe in it. Einstein never said it was a miracle. He said compounding numbers. Yeah, it's been misquoted. And compounding interest is slow and it's dangerous. Instead, it's about velocity. How can you improve the number of times money circulates through cash flow without having to increase what you put in? Efficiency, is it paying less tax, paying less interest, paying less fees that don't perform with investments, or less on insurance costs that don't actually transfer risk? This is where there's a lot of money. Other ways for velocity is to expand your means. How do you add more value? How do you reach more people? How do you get your dollar to do more than one thing? How can you create cash flow? I look in my early life, right? I bought some real estate. That real estate kicked off cash flow. I put that back into something called cash flow banking at cashflowbanking.com. I then got cash there, bought more properties or other investments. I even used, equity to pay off other properties. So now I had less loans with one, or I had it more efficiently. Like, I just kept my money in motion. And that money in motion created more wealth because my belief was, what if I can get 3 to 5%, 3 to 5 times, rather than 10% one time? That's velocity. It's how the economy works. And when you can employ personal velocity in your life, you can have better returns with less risk. Well, let's talk about returns on factor number 5. Chasing returns with speculation and risk will lead to short-lived gains at best. I mean, does this even make sense that high risk equals high return? I mean, risk just means chance of loss. How by increasing my chance of loss am I going to have a higher rate of return? I'm not going to. So people don't actually have risk tolerance. It's loss tolerance. Like, risk tolerance is where we go, hey, on a scale of 1 to 10, how much risk do you want to take? Well, if you believe risk equals return, you're probably going to answer a 10. But if I ask you the day after you just lost everything, you're probably going to punch me in the throat. It's a 0. You don't have risk tolerance. You have loss tolerance. So how do you minimize and mitigate risk? The professionals do it all the time. It's what helps them create more sustainable wealth. Do not lose money. The more you can create stability and security and invest in the things that you do know, and invest in yourself so that you can grow and add more income, and then get guaranteed returns by saving on interest and saving on taxes and saving on insurance costs, that's where you get so much further ahead with less risk. Some people ask me, Garrett, what about Bitcoin or cryptocurrency? What about gold? Or what about options trading? What about aggressive mutual funds? There's plenty of narratives out there to separate you from your money. Am I saying all those are bad? No, I'm just saying that a lot of people get caught up in the hype instead of in the knowledge. Nick Halleck, who wrote 5 Day Weekend with me, he's really good. He knows a lot about cryptocurrency. I've got other people I've met that really study gold at a deep level. Options trading is worthless. That's my opinion, because it's not creating value in the world. Who cares about you clicking a mouse? Start thinking about how you add value to the world. And aggressive mutual funds are a big way to aggressively separate from your money, overpromise and underdeliver. There's plenty of stories of startups working out and people investing early on and pre-IPO, and then it's a media darling and people get so excited because a small amount of money turned into a lot. But what about the hundreds of thousands that didn't get reported, that actually failed? That people put their money up that was hard-earned, and then they parted with it because it was risk, because they didn't understand it, because they didn't invest in alignment with their investor DNA. For every story of someone making it, there's plenty more of people that lost it all in those kinds of investments. Look, if you want to become a better investor, if you want to know how to avoid the mistakes, the myths, and the misinformation, if you want to know a way that you could store your money and do a lot better than a savings account without having to lock up your money like a retirement plan and have something in between, well, go to wealthfactory.com/megakit, where you learn how to keep a lot more control over your cash, improve your cash flow, and avoid the myths and misinformation by getting 2 of my books on me. Download them right now, plus get a cash flow guide. wealthfactory.com/megakit. All right, number 6, and there's plenty of this right now. There's people that are poor and that are running scared right now. They divest at times of fear when they have losses, and then they jump back in when hysteria ensues, right? So like hot markets, everybody hears about it, they finally get involved at the very end, and then it collapses. Then they're burned and they just stay out of it. I'm not gonna get involved, and they wait and they wait and they wait until everybody's doing it. Then they jump in, and it's this teeter-totter of money that's getting transferred to other people's hands and people saying that they lost it. Look, part of the fear isn't looking at what is actually going on, or getting angry at anyone that doesn't confirm your existing beliefs, or doing something because everyone else is saying that you should, or not trusting in your personal ability to add value and understand who you are and what you're capable of. This is critical that you learn how to invest in yourself and that you learn how to be the driver of your production and profits, not a passenger that has no control. If you're always relying on someone else and everyone else, you're very susceptible to markets that you can't control and situations and scenarios that may not be right for you. And look, money can be pretty intimidating, right? Money can be something that feels complicated, or just only a few people understand, and there's plenty of myths that would have people believe that money is somehow the root of all evil, even though they want more of it, or that someone with money did something wrong to get it, or that they wouldn't be able to keep their relationships if they had more money, that somehow you've changed. There's also this thing called the poppy seed syndrome, or the crabs in a barrel issue. Poppy seed is if one grows higher in Australia, let's cut it down, and so that's the individuals that rise above and people try to bring them down, or the crabs trying to get out of the barrel and the other crabs are pulling them in. Like, maybe it's time to stop being so concerned what other people think and be who you are. To be the greatest version of who you are, to bring those talents and abilities to solve these problems out there in the world. I mean, what would success, money, value, or growth mean to you? What responsibility would that take for you in your life to own what you're capable of? And look, does it really matter what those people say about you? Maybe it's their own fears and inadequacies that are coming forth, and maybe you could be the example of what's possible. But the most important thing is just be responsible for your side of the equation, for being a value creator, for not getting sucked in to the myths of scarcity or less production or being less than who you are. Now, the 7th issue here is people that don't know how to manage a mortgage or a student loan, and they say once those are handled, then life will be different. So a lot of times people are trying to pay off a mortgage or student loan at the expense of actually investing in themselves. So first we have to understand there's a method versus an objective. When it comes to a method of paying off a loan, that might be, do you pay extra? Do you have a side account? Can you earn interest and then pay it all off in one fell swoop? Is there a way to maximize tax deductions or control of your money? Or objective might be, I just want this paid off. Most people collapse the two. So if your objective is to pay off a loan and you no longer learn the best ways to do that, you set yourself up for risk. I've had people that have argued with me here on YouTube where they're like, oh, well, if you pay that off, then nobody can beat you, or then you're totally fine. I'm like, that's fine if you want to pay it off. But how do you get there? What if you're paying extra to a mortgage and you shorten your mortgage, and so now it's a high payment, you got a lot of money trapped in that equity, and we have a really high unemployment rate right now, and we have a lot of people earning less money right now. What if they cannot make that payment? They're now at risk of being foreclosed on, where if they kept the money on the side, or they had it in cash flow banking where it was safe and secure. Do not go throw that into speculative investments like the stock market. I'm just saying keep more control of your money. Now there might be a faster way to pay it off, or a safer way in order to get there. I really believe in liquidity versus tying up capital. I believe in making sure to invest in myself and having others invest in themselves so they continue to grow and expand rather than shrink. And there's no contingency planning by just paying extra and shortening a loan, because you're in equity jail where the bank now has control over that, whether they're going to lend it to you and you either have to sell the home, which might be at a time where the economy's not good or real estate takes a hit. And for those that want to argue, just go back and research 2008 and 2009. I'm here to help. I'm not working for a bank. I'm not being paid by a bank. I don't have a dog in the fight. I just want to make sure that you're using the most efficient, effective ways of protecting your cash and yourself. And part of understanding this is knowing your cost of money. Your cost of money is your highest long-term rate of return that you can earn, or the highest interest rate you pay for use of money. So a credit card at 16% might be your cost of money. Or maybe you have an investment you know you can get 5%. That might be your cost of money. So look at your cost of money before you just pay something down. Look at the tax ramifications of paying something down. And be careful of Depression-era thinking. In the Great Depression, the bank could come and say, hey, we need you to pay off your home. Now, you might not have the money to pay it off, so they foreclose on you. There aren't that, in the United States, no bank can come and say, you've been making your payment, you've never missed, we're going to foreclose on you. That's not how it works anymore. They changed those rules. Some people didn't change their emotions, but the rules changed. All right, the eighth piece is leverage. There's a lot of people that try to borrow money without enough knowledge. They go over leverage with real estate. They go borrow a bunch of cash to invest in something really speculative. I know people that got student loans to buy cryptocurrency. I know people that have bought a huge real estate portfolio, but all it took was a few tenants not pay their rent on time or an economic change that decimated them. See, don't go leverage anything other than mental and relationship capital, which are part of your investor DNA. Increase your financial intelligence and your knowledge. Figure out what investments make sense based upon who you are and what you know. What are your core values and drivers and competencies? And then you only invest in a focused way, and you focus first on cash flow and making money on the buy, not speculation and waiting for 30 years hoping that it's going to work out. If you don't have the mental capital, meaning you don't know what you're investing in, why it would work or how it would work, don't invest. That's speculation. If you don't have the relationship capital, which could be the right attorneys or asset protection or bankers or due diligence team or exit strategies, make sure you've got the right team around you to support you so you can avoid some of the missteps and mistakes and minimize the amount of losses. So don't go borrow or leverage before you're ready. I did a video with Robert Kiyosaki, and he had like $300 million he talks about in loans. Now, hopefully his real estate's worth a lot more than $300 million and his assets and his liquidity, but people jump all over like, that's stupid, why would you ever do that? Well, he's got a different mental capital around real estate. He has different relationship capital around people that want to buy real estate or partner with him on real estate. So that could be a great thing for him and a terrible thing for others. All right, the ninth issue here is lack of liquidity. We have to recognize most cash accounts don't pay any commissions, so advisors sell these because they don't get paid on it. If you think things will always go great and be great, well, you're at risk. You've got to have contingencies. You've got to have an ability to act on opportunity. And if you don't have cash around, then when the biggest distressed opportunities are out there where you could buy something at a deep discount, you could be profitable from day one, there could be amazing cash flow because of the situation. Those without cash, those opportunities pass them by. Those with cash can make money on the buy. And the last piece here is, why do people trust in Wall Street? If I think about like the top 3 movies about Wall Street, it's Wolf of Wall Street. Are wolves like really friendly animals? I don't think so. Wall Street, just that show that we had Gordon Gekko, one of the sleaziest people, bad guys, played by Michael Douglas. Boiler Room. I mean, this is all about how people are separated from their money. I mean, would we trust Wall Street with our kids? I mean, hell, if I gave them the kid, I'd probably go back and they say, oh, we lost 8%. Hopefully it comes back. I'm like, 8%? Yeah, toes, fingers, it's fine. Like, they are not trustworthy in any way, shape, or form. We've seen Goldman Sachs continue to pillage absolute economies and nations with no ramifications. Go watch The Big Short. It's how long do we have to hear this narrative? The stock market's only actually gotten 6% for the last 20 years, so 84% of the gains went to 10% of the investors. It's time to take back control of your finances. It's time to focus on cash flow. It's time to look at economic independence. It's time to bet on yourself rather than on other people that don't have your best interests in mind. I mean, think about the Wall Street. They underwrite IPOs, initial public offerings, and they always have a positive recommendation. Why? Because they're getting paid for that, not to be your advocate, not to do due diligence. I mean, when do they not tell you to invest, right? They're like, hey, market's up, get on board. Hey, the market's down, it's on sale. Hey, the market's stable, it's poised and positioned to go up at any time. Look, they earn the name wolves. So don't let them eat away at your money. These are 10 points that once you understand them, you can avoid the mistakes. The majority of what you've been taught about money and investing is wrong and will make you poor. From compound interest to being in it for the long haul, to handing your money over to Wall Street, or taking risks to try to get a rate of return, or trading your time for money. Now that you know the top ways that could destroy your wealth, I hope you can make better choices and decisions, avoid the landmines, and recapture and take control of your financial life. It's time to put an end to these myths and mythology in your life. Now you have the knowledge to transform your thoughts into profits and build the life you love. If you're looking for more on this topic, check out my video on the 5 things broke people say that keep them broke. You'll learn how the conversation of the wealthy differs from that of the poor, and how to change the way you speak to allow you to reach wealth and economic independence. I'll see you there.